Cash flow versus capital growth. What's smarter in today's market? If you've been researching property investment, you've probably heard the big debate. Should you invest for cash flow or for capital growth? In theory, cash flow sounds amazing. Who doesn't want a property that pays you every month? But in the current Australian market, being cash flow positive is getting harder and harder than ever, especially in our major cities. So let's unpack the differences between the two strategies and which one actually makes sense in today's climate. What is cash flow? Well, cash flow is the money you have left over after all the expenses, mortgage, rates, insurance, property management, maintenance are paid. If there is money left at the end of the month, that is cash flow positive or positive cash flow. If you're topping it up from your own pocket, that's negative cash flow. Positive cash flow helps with your lifestyle, gives you financial breathing room, and can help service more loans. But here's the truth. In today's market, especially with interest rates where they are, positive cash flow is rare. Now, why is cash flow so hard in Australia? Let's be real, property prices have surged over the past few years, and so have the interest rates. And you combine that with the rental yields that haven't quite kept up, and suddenly even properties that used to be cash flow neutral are now costing you money to hold. In cities like Sydney, Melbourne, and even Brisbane, it's almost impossible to buy a well-located property and have it pay for itself from day one. Unless you're putting in a massive deposit or you're buying in a regional pocket where the yields are higher, but the growth is evidently slower. Now, what is capital growth? Capital growth is the increase of your property's value over time. So say, for example, you buy a property for $600,000 and it grows to $850,000. That's a $250,000 increase in equity, which you can potentially use to buy the next investment or the next property. This is where most wealth in property is created, through time in the market, location selection, and compounding growth. Even if a property is slightly negatively geared, strong capital growth can far outweigh those holding costs. So what should you focus on in 2025? Well, right now, in this market, chasing positive cash flow as your main strategy isn't easy, and in most cases shouldn't be your only goal. So here's what smart investors are doing. They are targeting high growth areas, even if it means a little bit of negative cash flow for the short term. They're managing their loan structures and buffers wisely, and they're looking for properties with value add potential, things like renovations or granny flats, to improve the cash flow over time. Let's compare two scenarios. Property A, positive $50 a week, but barely grows. That's $2,600 a year in your pocket. It's not bad. But property B, slightly negatively gears, but grows $40,000 over a year's period. After 5 years, that's $200,000 in equity and more borrowing power. The investor with capital growth is in a stronger position, even if it costs them $2 to $3 grand per year to hold. That's the power of growth. And that's why a little negative cash flow isn't always a bad thing. Cash flow still matters, but think of the bigger picture. You need to hold the property comfortably. You need buffers in place, and you don't want to be stressed every time the RBA meets. So don't fall into the trap of thinking that cash flow is everything, especially if the property isn't going to grow in value. At the end of the day, it's capital growth that creates wealth and cash flow that helps you keep it. The most sustainable strategy? Invest for growth and manage for cash flow. That means buying in the right location and setting up the right loan structure and being smart with your expenses so your portfolio can grow and remain manageable. And remember, cash flow can improve over time, rents can rise, loans can be refinanced, but capital growth is what moves the needle on your wealth. So in today's market, don't get discouraged if a property isn't cash flow positive on day one. Focus on the fundamentals. Buy well, plan long term, and remember, it's not about getting rich overnight, it's about building sustainable, growing wealth over time. Still not sure which approach suits you? Hit the like and subscribe button and book in a chat with our team. Jay or myself will help you map out a strategy based on your goals and your finances. Remember to like and subscribe, and we'll see you at the next video.